All right. Today is Tuesday, October 4th, and this is a recap for the stock market activities today. And folks, I got a good one for you tonight. I'm already fired up and ready to go, and hope you feel the same. Because, folks, this stock market had an ugly September. One of the worst Septembers in history. Matter of fact, the performance of the stock market year to date is the worst since 1931. I wonder what happened back then. I'm not really sure. I wasn't alive back then. But I read about it, the Great Depression. You know, the bread lines, the good old times. You know, Grandpa said that the bread lines were the best place to pick up chicks back then. All what you had to do is brag about your pea soup-filled fedora, and they immediately asked for the snap. But anyhow, here in the new Great Depression, new and improved Great Depression, the stock market has lost over $46 trillion so far. Just think about that.
Think about what you'd think about.
And they say that the pain will not stop until we see a pivot from the Fed. The Fed has to say, okay, no more. We're done. And the question right now that October started on a positive note with massive rallies in the last 2 days. Has the Fed pivot been found? Because looking at the market action, it appears that the market found the pivot. Problem is, I don't find the pivot anywhere. How about you? Did I miss it out? I know I was absent yesterday. Did the Fed come out and say, hey folks, we're pivoting. You're now allowed back in the casino? Because I might have missed it. I don't know. You see, the stock market is a junkie, a drug addict. And it has been this way for at least 10 years. And the market's drug of choice is quantitative easing, aka the Fed's cocaine. The problem is, now that the drug dealer, the Fed, says, hey, no more, I'm not supplying you with drugs anymore, the market is in a withdrawal stage, and it needs to go into rehab. But it is resisting. It's saying, I'm not going to rehab. I'm not going to sober up. Instead, I'm going to try to seduce the dealer to resupply me with the same drugs again. This is, of course, lunacy. It is la-la land. It doesn't make sense at all. But the question is this stock market rebound, bounce, rally, whatever you want to call it, doesn't matter to me. But is it legit? Is this one different because we have a pivot? Forget about the pivot happening right now, but do we have the ingredients for an upcoming Fed pivot? Because if we do, the market looks ahead. It's going to move ahead of the Fed. In answering this question, and it is important, do me a favor and grab your detective hats because we need them. And let's do the investigation using the facts and the data. You see, the market was supposed to start on a really ugly October. And the reason is, over the weekend, Tesla produced its delivery numbers, and while the number was impressive, it missed analysts' estimates. Now, we talked before about bear market behavior, and usually the last two blocks to fall, the last two stocks to fall, are the stocks where the core faith of institutionals and retail resides. And in this case, the institutional faith is in Apple, the retail faith is in Tesla. And we know that the valuation of Tesla is insane and ridiculous, doesn't make sense at all, but we're okay with holding our noses and say we're going to justify this valuation so long as the growth story in Tesla is intact. But what if the growth story in Tesla is negated? And this is the first warning sign that the growth in Tesla might be indeed slowing down, and hence the negative reaction that we got on Monday. And by the way, over the weekend, we talked about the bull versus bear thesis regarding Tesla and my opinion of why Tesla will fall apart. You can watch that video and many more in the members only section of the channel. You can join if you have the means to do so to support the channel and enjoy such videos. But if you can't do that, you can still support the channel by clicking the like button, the subscribe button, and leave a comment what you ate for breakfast. That's all I need to know. And if you say, hey Maverick, I did not eat breakfast today, I'm on a diet, just type a sad face, because I don't believe in diets. When it comes to breakfast, I'm all in. The Grand Slam Deluxe, baby. Eggs, sausages, bacon, hash browns, toast, fruits. Just bring it on. I'm a hardcore believer in breakfast, and if you don't believe me, ask my waistline. Anyhow, what are we talking about here? Oh yeah, we're talking about the market and the pivot. And now that you have your detective hats on and you're looking all cute, let's do some investigation here. What moves markets? The answer is 3 components. Number 1, and most importantly, the fundamentals. And by fundamentals, we mean the Fed's policy, the taxation policy, the macroeconomics, geopolitics, etc., etc. And then we have the technicals. That is clear and self-explanatory. And then we have the mechanics, and that means options, the VIX, short squeezes, gamma squeezes. All of these are mechanical reasons for the stock market to move up or down. Now, for any rally or decline in the stock market, the more fundamental reasons behind such a move, the more supportive it is, and the more sustainable it is. The technicals, the mechanics hold less weighting than the fundamentals. They're certainly important, but what keeps rallies or stock market declines sustainable is the weighting of the fundamentals. Now, when we talk about the technicals, we talked about September being an ugly month, a historic ugly month. And in 2022, September did deliver one of the ugliest declines in stock market history. So we have a lot of oversold conditions in the stock market, which suggests that short covering might follow, and that produces rebounds, and hence we have a technical and a mechanical setup for a rebound rally. On top of that, we have three important technical indicators that I've been watching. Number one is Apple 150. Number two, the June lows, specifically in the S&P 500. And then the S&P 500's 200 weeks moving average. If all three taken down, there is very little support for a technical rebound or technical bounce. The technicals become more favorable to more downside in the stock market, not an upside. So far, we have Apple 150 gone. The June lows were gone for a day or two, but since then, they have been recaptured, and the 200 weeks moving average remains intact. So we know that we have technical reasons for a bear market rally. But most importantly, when we talk about the technicals, two things come to mind. Two things that have been supporting the stock market decline. Number one, the dollar. Number two, yields, but specifically the 10-year yield. They've been rallying impulsively higher in the month of September. So if they pull back, and better yet reverse, then we have a technical case for the stock market to rebound higher. And the question here becomes, do we have the fundamentals that support a decline, let's say a sustainable decline in the dollar and yields? Because if we have such fundamentals, then yes, the stock market rally has legs. And that means it has more odds of becoming sustainable. And perhaps one of the reasons behind the pullback in the dollar and yields was a pivot. But no, it's not a Fed pivot. It is a pivot from the UK government that we got yesterday. You see, the Chancellor came out and said, hey, we hear you, we got it wrong, and we're going to fix it. So we're going to do the U-turn on the taxes, no more fiscal stimulus, no more fiscal spending. He did not resign, but that was good enough for the sterling to rally higher and for the dollar to go down. But folks, in reality, watching the stock market on Monday, was the pullback in the dollar due to the U-turn by the UK government the real reason behind the rally? Not really. There was something that happened before, which is the main subject of this video. We'll talk about that in a second, but there was a third item that supported the big impulsive bear market rally on Monday, and you can see the move tick by tick in real time. The moment we got the manufacturing PMI, the stock market shot up higher, and the manufacturing PMI came out abysmal, indicating that the economy is indeed heading into a recession. So why would the stock market celebrate that? We go back to the junkie mentality. The stock market looks at a piece of data, in this case the manufacturing PMI, really weak and weakening, and says, hey Fed, look, we need more drugs. You're overdoing it here with the tightening, and this piece of data is going to force you to resupply the market with drugs. We're not talking about pausing interest rate hikes. We're talking about cutting here. This is what the market thinks, of course. In other words, the market is rallying based on recession optimism. And in any bear market rally, we always ask the question, is the market fighting the Fed? Because if the market not fighting the Fed, then this is a legitimate bottom and the rebound is sustainable. But if the market is fighting the Fed, then this bear market rally is not sustainable. It's going to reverse, just like we saw many bear market rallies this year do the same. So far in the data that I presented for you, the UK government U-turn, the manufacturing PMI, is there any indicator here that the Fed is indeed pivoting? Or is the market, based on the data that I gave you right now, is yet again fighting the Fed? The answer is the market is fighting the Fed once again. However, remember last week when I produced a video titled Dark Powell, and we went over the conference by Jerome Powell, the FOMC, and there is a Fed insider who gave me two important indicators to look at. And this Fed insider is Papa Jerome himself. He said, and I'm rephrasing of course, I'm just telling you what he really actually said. In the look for a pivot, we should be looking at the core PCE inflation, number one, and number two, jobs openings. The Fed would like to see core PCE PCE moving down, and the Fed would like to see job openings moving down. And they need to see those two pieces of data doing the same, not just for 1 month or 2 months, but maybe 3. And then they can be comfortable in saying, okay, we've done enough. It's time to slow it down. So we're not going to increase as much, or we're just going to pause and hold. Now, the market thinks that the Fed is going to cut rates. That's delusional. But a pause and hold is good enough to produce a rally right now. The question is, core PCE came out last week, and it went higher month over month. So we don't have any relief from core PCE. But today, this morning, the bulls got perhaps the most significant and impactful piece of data that supports a market rebound. And this piece of data is jobs openings, which came out today light. They were down by 1 million postings. They're still sky high. The Fed needs to do more, but this is good enough to say, okay, what the Fed has been doing so far is showing up in the data. And the market looks around and says, okay, that means that we're getting closer and closer and closer to peak interest rate hikes. And I say forget about peak inflation, forget about peak interest rate hikes, forget about the Fed pivot. They're not going to pivot. What the market should be looking for instead is what is the restrictive rate which the Fed will hike all the way to that number and then hold. Because once we identify this number, we know when the bottom is going to happen. And a major decline in core PCE and a major decline in jobs openings tell us that we're getting closer. The problem is, we don't have a steep decline in core PCE, but we have a steep decline in jobs openings. Hence now, the market has not only technical reasons, but it has fundamental reasons to push this rally higher. Even though for now, the assumption is that this is just another bear market rally, and soon enough, down we go. But perhaps the best evidence that the bulls have in support of this rally is the fact that Jim Cramer came out yesterday and said that this rally is temporary. And now even I'm asking, is this for real or what? Am I missing something here when I find myself agreeing with Cramer of all people? But look, the market's assumption of an upcoming Fed pivot will be tested aggressively so this week and beyond. Test number 1 will be jobs data. We're going to get some of that with the ADP report tomorrow. And then we have the big jobs employment report on Friday. We also have next week the CPI. And if the CPI goes higher, forget about the rally. Goes kaputs. And then we have earnings. And if earnings come out ugly, the rebound goes kaputs and the bear market resumes. But most importantly, it's all about inflation. Not just the CPI reading, but actual inflation. You see, the blind spot in the mirror for the bulls is the fact that commodities have been rallying significantly in the last 2 days. As the dollar pulls back, energy commodities are shooting up higher, and we have another catalyst coming out tomorrow, which is the OPEC Plus meeting. We have news that both Saudi Arabia and Russia are about to induce a major production cut. And therefore, last week I said, if you're going to bet on a rally based on the pullback on the dollar, stick with commodities. Because these tech names, these trash names, they might catch a short covering rally and then reverse right away. But the sustainability element here is with commodities. If the dollar continues to go down, commodities will go higher. If the Fed pivots, commodities will go higher because the fight against inflation is not done. Inflation remains in control. This is what the Fed, the market participants are not getting. You will never be able to defeat inflation at a rate above 8% with a Fed funds rate at around 3.5%. Not going to happen. Folks, we're going to dig deep on this issue of the market, assuming that the Fed is going to pivot because fill in the blank. I have more videos coming for you this week. We're going to talk about this issue a lot more. But for now, let's move on to cover the stock market information for you. We start with the closing of the indices today, and here we go. The Dow Industrial Average up by 825.43 points, or a gain of 2.80%. The Nasdaq leading the pack with gains of 360.97 points, or a gain of 3.34%. The S&P 500 also in the green by 112.5 points, or a gain of 3.06%. The sector's performances today all in the green, and coming up number 1, capturing the gold medal, cyclicals. At number 2 for the silver, technology. Number 3 for the bronze, financials. Notice the theme here. Yesterday, leading the rally was energy, utilities, REITs, materials. It was a defensive theme. It was a value kind of trade. Today, we're seeing the opposite. We're seeing defensives, utilities, while being in the green, they did not lead the market rally today. What led the market rally today was the offensive theme of cyclicals, technology, and financials. What does that say? It says we're seeing more confidence here in this rebound rally. We're seeing folks saying, okay, this is the real thing, and they're jumping in. Now, whether they're jumping in a hole or they're jumping in the real thing, that's a different story. On to the advance to decline ratios. NYSE 93% advancing versus 7% declining. The Nasdaq 84% advancing versus 14% declining. With such exaggerated ratios to the upside, the risk of a pullback is highly likely at this point. Moving on to futures, commodities, what's going on here? A rally across the board with very few exceptions. The dollar was down almost 1.5 points today. 1.5%, excuse me. The euro, the Swiss franc, even the sterling were rallying today, and that added pressure on the dollar. Now, here's the thing for you. Spoiler alert on whether this rally is sustainable or not. The moment the dollar catches a footing, the bear market rally goes poof, gone. When will that happen? We have macro data coming up. We talked about that in the intro of the video. We'll talk about that again in the conclusion of the video, but we're seeing short covering here in the British pound and even in the euro. Once the short covering is done, the dollar is going to find footing. And when it does, the market goes down along with commodities. But for now, the party goes on, and energy commodities led the party. The WTI with gains of over 3%. So did Brent. Gasoline RBOB, major rebound, worth over 6% today alone. Heating oil futures were up over 4.5% today. Natural gas up almost 5.5%. And folks, the catalyst, besides the dollar moving down, is tomorrow we have OPEC Plus, and the anticipation is OPEC Plus will cut the production by a lot. Some would say by over 1 million barrels. Now, I've been telling you this for a while. We have the Fed. Jerome Powell controls the stock market, and we say don't fight the Fed. If the Fed is tightening, it is lunacy to buy the dip and say the stock market bottomed. You're fighting the Fed. Likewise, betting against oil and saying that energy commodities have topped, or we have peak inflation, or oil is done, it's going to go down from this point on, you're fighting the Saudi Jerome Powell, the oil Jerome Powell. And this is the energy minister from Saudi Arabia. And he said clearly that if he sees prices going down in a speculative manner, he's going to fight back. And he will fight back by substantial cuts. And this will push oil prices higher. Now, what's really crucial about all of this is, remember last year when the prices of gas at the pump started to rise higher, the Joey B administration decided to deplete the SPR, the Strategic Petroleum Reserve, by 1 million barrels per day. Almost a year later, oil prices are down, not by a lot, and now what? The SPR is depleted, and this has been the plan by the Saudis since the get-go. Once Biden decided to deplete the SPR and push prices down, the Saudis had two choices. Choice number one, start a tit-for-tat war against the United States and say, okay, Joey B, you want to increase the output of oil by 1 million barrels per day? We're going to cut 1 million barrels per day. That would have been a tit-for-tat war against the US, and it would have been a stupid strategy. But the Saudis had a smarter strategy, which is option number 2, which they ended up choosing. And this option is sit down, calm down, watch the Joey B administration deplete the SPR, and yes, oil prices will go down by a little bit, but once they're done, once America has depleted its SPR and they have no other choice, that is the moment when you strike. You strike when the iron is hot, and the Saudis are about to do that. Now they're going to cut supply, number one. Number two, the government here in the United States have to replenish the SPR. So they have to buy oil. That is extra demand while the supply goes down. What a genius decision by the Joey B administration. So all of you celebrating the market rally and the pullback in the dollar, you better drop on your knees right now and start begging for the dollar to go higher again. Because if it doesn't, we have triple tailwinds for oil to go higher. The cut in supply by the Saudis, the insane buying to replenish the SPR by the Joey B administration, and number 3, the dollar going down. Oh boy, you will see oil shooting up to 100 just like that. Anyhow, back to the futures. Softs had a decent day up across the board. Cocoa, cotton, coffee, lumber, sugar, all in the green. But OJ with a minor pullback. OJ has been blasting higher due to the hurricane in Florida. But now we're seeing some profit taking. When it comes to metals, green across the board. The dollar is down and metals like it a lot. And you know that this is a sustainable decline in the dollar. Actually, we knew yesterday because the old man gold was rallying higher. And the old man doesn't like to rally without a confirmation. What about meats? Down across the board. Lean hogs with a pullback of about 4% leading the declines in meats. When it comes to grains, mixed picture, but mostly in the green, led by gains for soybean oil, worth about 2.5%. We saw gains for soybeans, corn, rough rice, and oats futures. On the other hand, we have declines for soybean meal, most importantly wheat futures. Moving on to the options market, the big casino, what's going on here? The volume is moving higher, specifically for the most important names, Apple and Tesla. We're seeing some increase in the buying of calls, but not a major move yet. We're still seeing a lot of folks actually betting against the rebound by buying a significant amount of puts. In any case, at number one, the hottest table is Tesla, aka the souffle. With around 2.5 million contracts traded today, about 50% of those were calls. At number two, Apple, with around 1.2 million contracts traded today, about 56% of those were calls. And we talked ahead of the start of the week that we might see a decent week for Apple and an ugly week for Tesla. Why? Because the shorts are taking profits from Apple and they're rotating the bets for against Tesla, I should say, instead. Anyhow, number three, Amazon. With around 750,000 contracts traded today, about 58.5% of those were calls. The unusual activities, what's going on here? EWC, this is the Canadian ETF, more and more bets against Canada for some reason. And in this case, somebody bought the $30 puts for the expiration date, November 18th, with expectations that the EWC could go down and lose more than 9% of its value by then. They paid around 50 cents a piece to enter this trade, all in all spending around $1 million. What about the ticker R for Rider? Somebody sees more upside coming here for the name, and they bought the 85 calls for the expiration date, November 18th, with expectations that the name could rally higher and gain at least 7.5% by then. They paid around $2.25 a piece to enter this trade, all in all spending around $3 million. What about the ticker TSLA, Tesla? We got a rebound today, but we have a lot of news about Tesla and Elon. We'll talk about that in the heat map analysis, but somebody sees the declines that we got on Monday resuming, and they bought the 232.5 puts for the expiration date this upcoming Friday, October 7th, with expectations that Tesla could move down and lose at least 7% by then. They paid around $1.30 a piece to enter this trade, all in all spending around $1 million. What about the IWM? An impressive rally. The IWM, believe it or not, did not crack the June lows, unlike the SPY, the S&P, and the Nasdaq. And while it has been an impressive rally for the Russell 2000, somebody's betting that the tide is about to shift. And I actually followed this trade. The trader bought the 160 puts for the expiration date, October 28th, with expectations that the IWM will pull back and lose 9% of its value by then, at least. And they paid around $1.40 a piece to enter this trade, all in all spending around $1.5 million. And lastly, what about the ticker DRIP? This is the bear index for oil, meaning this is the reverse index for oil. If you happen to be bearish oil, you buy the drip. So somebody here is betting that oil will have a pullback. Why would that be? It could be buy the rumor, sell the news. Traders have been buying oil commodities and oil stocks ahead of the OPEC Plus meeting. The expectations are now set at 1 million barrels at least. If OPEC Plus comes out cutting, let's say, 500,000 barrels or 800,000 barrels, oil will go down dramatically. And perhaps this is what the trader is betting on. And they bought the 16 bucks calls for drip with the expiration date of October 21st with expectations that the name could move higher and gain at least 8% by then. They paid around $1 a piece to enter this trade, all in all spending around $750,000. Moving on to the heat map analysis. What's going on here? Nothing is going on. A sea of green, everything is lining up green, a sign of short covering here. The sustainability of the rally depends on whether the buyers, the legitimate buyers, are going to step in and start to comb through the gains and pick which sectors of the market they believe in. This is how you'll know whether this is sustainable or not by looking at the map alone. But in my opinion, and it has been working so far, stick with commodities-related stocks. If your thesis for the rebound is a pullback in the dollar, stick with commodities. And I gave you a bunch of names. I gave you Oxy. I gave you Devon Energy. Devon Energy, by the way, is up almost 15% since last week. I also gave you the GDX, the Gold Miners ETF. All of these scored massive gains since then. The rational decision right now is, if you've been holding call options, take some off the table, book your profits, and play with the house money. Maybe commodities-related stocks will continue to rally because we have more downside for the dollar. But what if the jobs report comes out really strong, indicating that the Fed has to do more? What if the CPI comes out really strong, indicating the Fed has to do more? What if we have a technical rebound for the dollar? What if we have oil prices surging higher, and in response the dollar moves higher with expectations of more Fed tightening? A lot of things could go wrong. Therefore, I say always be closing. Now, let's talk about the major market movers, and we start with Tesla. The souffle was down big yesterday, of the news over the weekend of the deliveries number. And what upset the stock is the deliveries were impressive, but they did not meet analysts' estimates. Well, the analysts came out and said it doesn't matter. We're the most bullish on Tesla since 2015. And this is perhaps a sign that you should bail out. If that was not enough, Mama Cathy Wood, of all people, is buying the dip in Tesla. Another sign that you should run for the hill. Maybe if Jim Cramer buys Tesla, that would be a confirmation. But here's the big news about Tesla and Elon Musk today. Remember the whole Twitter fiasco? He's buying, no, he's not buying, and they're going to court, and yada, yada, yada. Well, Reverend Elon did a 180 and shocked the world today by saying, you know what? I'm going to buy Twitter. Same price, no bargaining. No negotiations at all. I'm just going to take the deal. And immediately, my alarm bells, my suspicions were all over the place, haywire. And I know a lot of you are going to say, hey, Maverick, we know the deal. Elon is now embarrassed that he's going to be deposed, and he perhaps want to hold certain data from the public, certain communication from the public, and he'd rather pay $50 billion to hide all of that information. Look, grab your tinfoil hats, because my conspiracy theory is way bigger than this one. On scale 1 to 10, think Alex Jones. So I'm not going to share it with you, but I'll give you a hint. See, the Rev made the decision yesterday, last night. What was he doing yesterday before he made the decision? The answer is he was going back and forth about this Russia-Ukraine thing. Elon Musk tweeted this. He made a poll and he said, in a Ukraine-Russia peace proposal, number 1, we redo the elections in the 4 regions that Russia just annexed. We do legitimate elections and let the chips fall wherever they may. Number 2, Crimea, which was always Russian to begin with, until the mistake by Khrushchev. So Reverend Elon says that goes to Russia. And then he says the water supply to Crimea is assured and Ukraine remains neutral. 59% of the voters said no, about 41 said yes. This is a reasonable proposal for peace, which a lot of observers proposed long time ago. It's just that we don't want it, the Ukrainians don't want it, and immediately Reverend Elon was attacked by the Saliva Ukraini cult, and I love to watch that because Elon has his own cult. Now he's getting attacked by the Saliva Ukraini cult. You know, the people with the sunflower emojis on their Twitter handles. A year ago, they thought Ukraine was a Marvel character. Now all of a sudden, they're geopolitical experts. But anyways, they came out accusing Elon of being pro-Russia and a Putin puppet. Elon came out and said, look, I'm just being realistic here. I'm saying this is how it's going to end either way. The question is how many to die before that? How many Ukrainians are going to die? And then he made another poll where he asked, hey, should the people living in these regions that Russia annexed decide their own destination by voting? 59% said yes. 41% said no. And in response to all of this, Ukrainian clown Zelensky came out and said, which Elon Musk do you like more? The one who supports Ukraine or the one who supports Russia? How about the one who supports Belize? Because this is where his offshore account is, with about $300 million in, and that was before the war. Now look, I'm not saying that this is pre-planned and we've been paying this guy for years, even before he became president. I'm not saying any of that. I'm just saying maybe being a comedian in Ukraine pays a lot. So if I failed in YouTube, I'm going to move to Ukraine and crack some jokes. Anyways, let's move on before we get banned and talk about dividends. You like dividends? I do. And since we're talking about Ukraine and money laundering, here's Lockheed Martin hiking dividend by about 7% as the Ukraine thing drags on. We also have Honeywell hiking dividends by 5%. Likewise, we have Starbucks also increasing their dividend. Which one of these three I like? The answer is clear. LMT, Lockheed Martin. It has the best fundamental of all of these names. The only headwind for LMT Lockheed Martin is if we have a peace agreement in Ukraine. So I'm talking against my book here. I'm advocating for a peace agreement in Ukraine, which will be bad for my investment in LMT. But I think peace is more important than money. Maybe I'm different. I don't know. Anyhow, what about the iMob, Apple? Morgan Stanley came out and said, remember the store revenue? All the Apple pumpers say, hey, it doesn't matter if iPhone sales are slowing down or not. The growth engine of the company is still intact. What is the growth engine? The answer is the store revenue, aka the racketeering operation, aka the rent.
Came for the rent. Don't run.
You see, the iMob has this store, and any transaction you want to do in the store, they get a cash 30%. Otherwise, they crack your kneecaps. They ban you from the store. And this racket has been going on for years. But now Morgan Stanley says that even the racketeering revenue for Apple went down. Do you need any more reasoning to bet against Apple? I don't. And here's the last one, since everybody talked about it yesterday. Kim K got fined by the SEC. Apparently, the SEC, Gary Gensler, woke up from the coma, momentarily of course, before he went back to sleep, and he gave Kim K a slap on the wrist. Don't do it again. Hey, just pay $1 million in fines and go home. It's okay. And do it again, please. You see, a lot of you followed this tulip mania. I chose not to do that. I chose to warn you about it. And I got a lot of heat for it. You're missing out. You're a perma bear. Blah, 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 blah. What happened now? You see, when you have Kim K and Mia Khalifa pumping stocks and cryptos, it's time to go the other way. Anyhow, the heat map for the ETFs, a sea of green, and you know that this is a short covering rally by looking at the performance of growth and value. They're identical. What does that mean? The buying is algorithmic in nature. The buying is short covering in nature. Once we see a contrast where the outperformance favors one side versus the other, be it growth or value, that is the moment when you see the retail crowd, the institutions hopping in and joining the rally. But for now, it is a short covering rally. It is inclusive across the board. Commodities led the rally, be it oil commodities, the XOP, XLE, the OIH, be it natural gas commodities, be it gold and silver commodities. The SLV was up over 9% yesterday alone. And of course, in international, we're watching the EWZ, the Brazilian ETF. Yesterday, it blasted significantly higher. Today, it is muted, and the reason is we don't have a result yet. It appears that we have a runoff vote between Bolsonaro and Lula, and my bet here is whoever wins, Bolsonaro or Lula, the EWZ will go down, and the reason is the majority of the gains were front-loaded off the runoff optimism. No result, that takes the pressure off, and we see a relief rally in the EWZ. But once the result is in, and we know it's Lula or Bolsonaro for sure, EWZ goes down. This is my take. On to the charts analysis, and we start with SPY, the S&P 500, 30 minutes chart. What's going on here? The June bottom has been recaptured, that is 362.16. Not only that, the chart recaptured 368. And it recaptured today an important line of defense, which is 373.5. Now, the formation is of a bull flag pattern. But folks, I know a lot of you watch technical analysis by watching the candlestick patterns. The trend line is here. This is a shooting star. This is a bull flag, but you never really put the psychology into it. Think about the psychology. The bulls have been stung many times in these fake bear market rallies. Now we're seeing the first stage of a bear market rally, which is short covering. Then comes the gamma squeeze, then comes the quant funds, and then comes the retail. We're not seeing any sign of an upcoming gamma squeeze. We're not seeing any sign or any technical indicator that is really important that will trigger a buying spree by quant funds. Most importantly, the retail crowd got stung in these bear market rallies repeatedly. They have a sour taste in their mouth. You really think they're going to buy right now and hop into this rally and get hit again? They need to see more, and this will challenge the sustainability of this rally. On top of that, while we have a bull flag pattern, it is likely not going to play out right away, and the reason is the RSI is overbought. Number two, we have upcoming obstacles from the employment report, from the CPI, from earnings, from the OPEC meeting, from inflation, from the Fed. Maybe coming out and saying, hey, the market is wrong. We're not going to pivot. All of these are risks, and I believe that the retail crowd, the mom and pops, are aware of that right now, and they're going to be more cautious in jumping into this rally. But sake of the argument, let's say the rally continues and the bull flag plays out. The next resistance we have is 385, but if we have a pullback, then we have closing the gap, which now coincides with 368, which is an important support level. What about the daily chart for the continuous contract for the S&P 500? 2 days. Massive rallies. A lot of technical repair has been done because this rally so far erased what? 1, 2, 3, 4, 5, 6, 7, 8, almost 9 days worth of declines in the S&P 500. On top of that, the volume has moved down. This is yet another good sign for the bulls. Another one is the momentum indicators improving and firming up. On the other hand, the bears will counter and say, the rally is not sustainable because, number one, you look at the volume as a positive thing, but us bears look at this as a lack of conviction in buying, and that's number one. Number two, you don't even have a confirmation on the MACD that the bearish momentum is over. Number three, this is typical of bear market rallies. They tend to erase multiple days worth of declines. They tend to suck a lot of people in. They tend to fool a lot of people in by the magnitude of the rally. So for now, the bears are sticking to their guns, but they start to lose ground once we have a crossing in the MACD, once we see support lines such as 3,960 being recaptured, most importantly, once we see supportive fundamental news for the rally to continue. Otherwise, the bears are going to be proven right once again. And folks, while the daily chart shows encouraging signs for the bulls, the most important chart, or I should say a more important chart, the weekly chart of the SPX, the cash index, well, the RSI is not oversold, the MACD indicator is not oversold, and it is in bearish momentum, not bullish momentum. We have a confirmation for that. And we also have a lower low in the pattern. And if the pattern continues, the chart will go down all the way to 3,270 at a minimum. So you can rally all you want, sooner or later, you're going down. In other words, show me the money. The burden of proof is now in the lap of bulls. They need to show more, that this rally is the beginning of something new. Here's the Q's 30 minutes chart. What's going on here? The June bottom has been recaptured along with 280 as support. We have a bull flag pattern indicating higher highs coming, but the RSI is oversold. We talked about the psychology, so I'm not going to be surprised if the bull flag doesn't play out and we see a pullback instead. And if we do, we have the gap. That is support number 1, and then we have the June bottom once again. If the chart blasts higher, adding to the gains, we have 290 as the next resistance. I don't think the chart will make it to 290 in one shot. I think the risk is for a pullback versus for a one shot all the way to 290. Here's the daily chart for the continuous contract for the NASDAQ. The good news for the bulls, number 1, the June bottom has been recaptured. Number 2, the momentum indicators are firming up. Number 3, the volume moved down, but the bears will counter and say all of that doesn't matter. The volume moving down is a proof that we don't have conviction in the buying yet. The momentum indicators remain negative. We don't have a confirmation. And number 3, you're still within range, even after 2 impressive days worth of rallies. The support, the June bottom, the resistance at around 11,689. Am I supposed to be impressed by staying in range? You need to show me more. And here's the IWM 30 minutes chart for the Russell 2000. Over the weekend, we talked about 2 charts favoring the bulls, the rest favoring the bears. Chart number 1 was the IWM. Chart number 2 was the 4 hours for the VIX. Why was the IWM chart favoring the bulls? The answer is it never closed below the June bottom, and it made a saucer bottoming formation, unlike the SPY and the Qs. And therefore, we're getting the impressive rally, a gap higher. It recaptured the important support of 174.22. It has a bull flag pattern, but again, the RSI is overextended now. Market psychology still not on board with this rebound higher. So we could see a pullback to close the gap. We have a soft support at around 171.40 on the way, but if the rally continues for a few more days, the ultimate resistance stands at 183.25. But we have soft resistance from previous gaps at 178.60 and then 181. And it all depends on this chart right here, the dollar index, the Dixie. We have a confirmation on the daily chart that the momentum has turned bearish. We have a confirmation from losing 111.2 as support. We have a confirmation from the negative divergence on the RSI. But do we have the all-clear sign that the dollar has marked a top for the year? Not really. When we move on to a weekly chart of the dollar using the Fibonacci retracement levels, this is not a reversal at all. We could catch support from Fibonacci support number 1 at around 108.7. If that doesn't hold, then we have 105. And then if that doesn't hold, then we have the confirmation that the top is in. But until then, who's to say that the Dixie is not going to pop higher again? The tailwinds are a lot stronger than the headwinds, that's for sure. In the meantime, gold has been rallying. When I saw the rally on Monday for gold, I said, okay, maybe this rally has some legs. And the reason is the dollar. We have a confirmation now that the dollar is going to go down, at least in a pullback. What is that confirmation? Gold shooting up higher. Gold tend to be conservative, doesn't like to rally without a confirmation from the dollar. But now it did, and it recaptured not just 1,671, but also the important support of 1,685. Is that sustainable or not? That depends on the weekly closing for gold. Is it going to be above 1,685 or not? Above, we're good to go. Below, this was a sucker's rally, and the dollar goes higher again. But if the dollar continues to go down, it's not just going to be gold, the only commodity rallying. It will be most likely be joined with oil, or by oil, I should say. This is a chart of Brent oil, a daily chart, and we talked about the crossing above the sloping line of resistance. The chart had tough time crossing above this line, but the bulls have been patient so long as the chart held on the support of 85. And I said the crack, one way or the other, will be violent in nature. If the chart cracks below 85, we will see a capitulation flush down in oil. However, if oil crosses successfully above the sloping line of resistance and we have a retest and a confirmation, the move will be explosive to the upside because all of that energy will be released. Shorts are going to cover. Those who've been waiting on the sidelines to buy oil will have FOMO and rush in, and we will see a major move to the upside. What is the likelihood here now that the chart crossed above the sloping line of resistance? The answer is the likelihood is for an explosive move to the upside, not the downside, except of course if OPEC Plus comes out disappointing with the cuts. And if oil pops higher, what happens to this chart? The 10-year yield. The 10-year is going to pop higher again. For now, we have a confirmation of negative momentum. We have a confirmation from the RSI, from the negative divergence, but we don't have a confirmation from the chart itself. We're not going to have a confirmation until the chart loses 3.5 as support. Otherwise, if oil rallies higher and inflation expectations move higher, the 10-year is going to rally again, and this will put an end to the rebound rally. The TLT weekly chart, what's going on here? Nothing changed. The outlook is still negative. The MACD is in negative territory. The RSI, yes, oversold, but it could get even more oversold. And we don't have a lot of support here. So we could see a flush down in the TLT, which will come hand in hand with a rebound and new highs on the 10-year. So watch out here. What about the VIX 4 hours chart? It is having a hard time cracking above 33. That's for sure. But here's my take. So far, Monday and Tuesday, we got major rallies in the S&P 500. Big time. Why didn't the VIX collapse? Why didn't it go to at least 24.29? Why are we still seeing folks buying puts and downing the rebound? I think they're doing so for a reason. What the VIX is doing right now is gathering energy to pop once and for all above 33. And this will be yet again another fool's rally in the S&P 500. The weekly chart in the VIX still in positive momentum, indicating more gains to come. What about Apple, the big kahuna, daily chart? We have an oversold bounce at around the support of 138.79. It got us above 145. It is support right now. And the psychology goes as the following. Now that the chart went all the way above 145 and it is getting closer to the important number of 150, we know the 150 battle has been lost for the bulls. But the psychology says now that they're close, they're going to aim for a retest at 150 again. However, if they fail again, this will be a confirmation that down we go, and the chart will make lower lows. For now, the volume is down. That supports the rally to go on, but the momentum indicators remain negative. Nothing changed here. Tesla, an hourly chart. What's going on? Yesterday, as I was looking at these charts, now I was making a video, by the way. I just didn't get to finish it because, anyways, something happened. But I was looking at this chart, and it was a bear flag pattern for Tesla. But I also looked at the RSI, and it was oversold, and I said in my head, the bear flag is not going to play out. And indeed, it did not. We got a bounce higher in the morning, but yet another failure. The chart did not make it above 258.79. It is now forming yet another bear flag pattern, this time around with no oversold readings on the RSI. The likelihood is the chart has further downside to go. The Elon Musk 180 thing about Twitter, that is a cherry on top for the bears, that Tesla will indeed go down further. Here's the daily chart for Tesla. The bulls lost two important supportive evidence. Number one, the reverse head and shoulder formation, that's gone now with the loss of 280 as support. Number two, the cup and handle formation is now gone with the chart making lower lows. The bulls have no support here. The only support they have is going down to the lows at around 210, 220, and then take it from there. And lastly, moving on to tulips, Bitcoin, what's going on here? We got a second rejection at 20,000. Now it appears that third time is a charm. But if I had to lay a bet, I would say that third time is not a charm. This is a sucker's rally. They're fooling a lot of bulls in, and they're going to lose 20,000 sooner or later. Look at the RSI. It is overextended. There is a pullback coming, and losing 20,000 as support for the third time in a row is a major psychological defeat for the bulls, which could initiate the leg to the downside, which should take us all the way down to 15,000. And lastly, moving on to the conclusion of this video, what do we have on the economic calendar tomorrow? We have the ADP employment report. This will be really important. And then we have the S&P Services PMI. And on top of that, we have the Fed zombie from Atlanta, Raphael Boystick speaking. And with that, folks, this is all I got for you for now. Thank you for listening. Thank you for watching. I will talk to you again tomorrow.
This is basically everything that we have in our books at any given time, but what Eric was trying to do was to work these numbers for levels of volatility that fall outside of the standard VAR model.
What are those levels?
It's fairly complicated.
Simplify it.
The volatility levels are set using historic patterns, basically, and then stretching those patterns out another 10-15% roughly.
All right, so?
So we are starting to test those historic patterns.
When?
Today?